Welcome to the Chartered Accountant's Pen. In today's lecture, we'll discuss the International Accounting Standard 2, Inventory. We'll discuss in detail the objectives, scope, measurement, disclosures, journal entries, and also compare it with the US Generally Accepted Accounting Principles, Accounting Standard Code 330. Dear viewers, welcome to today's lecture. Let's begin with the objective of IAS 2. IAS 2 prescribes the accounting treatment for inventories. The objective is to ensure that inventories are measured accurately and that their costs are appropriately recognized as an expense when related revenues are recognized. IAS 2 applies to all inventories except work in progress under construction contracts, IAS 11 or IFRS 15, financial instruments under IFRS 9, biological assets under IAS 41. It primarily covers goods held for sale, in production, or in the form of materials to be consumed. Inventories should be measured at the lower of cost and net realizable value. The cost includes purchase cost, conversion costs, other costs to bring inventory to its present location and condition. Net realizable value is the estimated selling price minus the costs of completion and selling. IAS 2 allows two cost formulas: first in, first out, FIFO, weighted average cost. LIFO is not permitted under IFRS. If the circumstances that caused the inventory write-down no longer exist, and net realizable value has increased, IAS 2 allows the write-down to be reversed. However, reversal is limited to the amount of the original write-down. IAS 2 requires the following disclosures: accounting policies adopted, total carrying amount of inventories, inventory classified as merchandise, raw materials, WIP, and finished goods, amount of inventory recognized as an expense, details of any write-downs or reversals. Let's consider a practical example. A company purchases inventory worth $10,000. The journal entry to record this transaction would be to debit inventory account with $10,000 and credit accounts payable with $10,000. Let's assume, later the net realizable value falls to $8,500. The journal entry to record this would be to debit inventory write-down expense account with $1,500 and credit inventory account with $1,500. Now, let's assume the situation improved, which increased the net realizable value to $9,800. The reversal entry to record this would be to debit the inventory account with $1,300 and credit the inventory write-down account with $1,300. IAS 2 allows reversals of previous write-downs only to the extent of the original loss. This is based on the prudence, conservatism, principle in accounting. You recognize losses when they occur but don't recognize gains until they're realized. Let's compare IAS 2 with US GAAP. US GAAP is codified under Accounting Standard Code 330 for inventory. As per Accounting Standard Update of November 2015, inventory for FIFO or weighted average is measured at lower of cost and NRV. LIFO is allowed under US GAAP, but not under IAS 2. When using the LIFO, last in, first out, method, inventory is not just recorded at cost, but also subjected to a valuation test. That test is the lower of cost or market, LCM, rule. Market value is not the selling price. Under ASC 330-1035, market is defined as the current replacement cost of the inventory, constrained by a ceiling and the floor. Selling is net realizable value and floor is net realizable value minus profit margin. Therefore, if the current replacement cost is between the ceiling and floor, it will become the cost of the inventory and accordingly, journal entries are posted. US GAAP does not allow reversal of inventory write-downs. So, while measurement principles are close, the revaluation and LIFO treatment differ significantly. Thank you for watching this lecture from Chartered Accountant's Pen. Don't forget to like, subscribe, and hit the bell icon for more accounting and auditing updates.